Howdy, Jacob here. They're looking at Bright Horizons Family Solutions in the diversified consumer services industry. Just under 6 billion market cap on just under 7 billion enterprise value. 1.3 billion in revenue 10 years ago to 2.4 billion. So you're looking at about a 6% a year growth rate. That's fairly impressive. And then for their revenue is already back to what it was above what it was from pre-COVID levels, so that's great. The return on invested capital, however, did get dropped off quite a bit, so they haven't picked up their margins as much as what they were pre-COVID. So there's still room there to grow, I presume, unless it's a forever hit. Balance sheet shows just under 100 million in cash-like products with 19 million short-term debt, 944 million long-term debt. Cash flow statement shows increase in free cash flow, a little bit of an increase in capital expenditures due to acquisitions, maybe a little bit of reinvestment. Historically, they've repurchased a bit of shares, paid down debt maybe. So acquisitions are the majority of that free cash flow, with a little bit going to share purchases and a little bit of debt reduction. Their free cash flow is averaged about maybe 160 million over the last 5 years. So to have just under $1 billion in long-term debt, that you're looking at a good amount there. That's maybe 7 times. Let's see. You're looking at about just under 6 times their 5-year average free cash flow. So that is more than what I prefer, but it's not to say they can't get there. They just have to really focus on debt reduction with maybe 20 to 30% of their free cash flow for the next little bit. That'll dwindle that down quite a bit. But yeah, I think we're ready to start making some assumptions here. Revenue growth side, and really outside of COVID, they've had very solid revenue growth. You're looking at a business that's grown 8%, 7.6% year over year is their lowest outside of COVID. So I do think that there's a chance that they could keep that going, but return on invested capital is pretty poor. So maybe at the end of 7 years, I say, you know what, you're a market average type company. Let's assign a 16 PE to you. I think that's reasonable. And I think by then their enterprise value and market cap disparity is going to be very low. So maybe I'll bump it down just one. So it's 15 on the lower end of market history. Average, I should say, because the average has been about 15 to 16. So depending on what time period you look at. So we're saying a little bit lower than the market average, but still a solid company at the end of 7 years. As for margins, I do like that free cash flow is higher. I don't like that it's going down, but again, they haven't hit the pre-COVID squeeze of margins. So maybe let's go somewhere in between. Let's go maybe 7 and 8. And then for share repurchases, 6 billion, 1% would be 60 million, 90 million. That's a lot of their free cash flow. So let's just say they offset it with 30 million and they use, I guess we could say half. Okay, so this is saying about 65 million, which is maybe a third. 35 to 40% of their free cash flow going towards share repurchases, a 25-30% to debt reduction, and then the remaining to acquisitions that make sense, reinvestment opportunities. And we're saying the company stock price needs to fall 71% before you get the return we're looking for here. So just going to be waiting on this one. No need to rush it. Take my time to get the return I'm looking for. Hopefully you enjoy the video. Have a great day.